Welcome everybody to Santa Cruz Works Clinic Startup Equity Crowdfunding. I am your host, Doug Erickson, and I got the slides working here. We also have on the line Matthew and Adrian helping out today. Can you guys say hello?
Hello. Hey, how you doing?
An enthusiastic hello from Adrian. Additionally, we are supported by a very talented group of team of people. Names and photos can't do them justice, but that'll have to do for now. And we're supported by the generosity of our sponsors. Thank you to each and every one of them for contributing to the success of this very unique and vibrant community. We need each other, of course. So if you like this event and any of our community services, here's something you should know. We are a nonprofit events and news organization, and we rely on people like you to keep us going. Every member makes us stronger and better. Every donor helps us deliver the jobs and the skills that we need for a vibrant tech ecosystem. So join us. Please go today to santacruzworks.org and join us. Today's program, we're going to start out with Krishan Arora with the Arora Project, and then we're going to dive a little bit into sort of the basics of venture capital and funding 101. Toby Corey will be delivering that, and then we'll jump immediately into the Fireside Chat, where Toby will lead discussions with Krishan Arora of Everydae, Todd Thompson of Carnot, and Joshua Resnick with Parallel Flight Technologies. So without further ado, Krishan, why don't you light up the video here?
Hello, everybody. How are you doing today? Awesome. Well, thank you, everybody, for joining us today. And thank you so much, Doug, for that great introduction. And what we're going to go over today is going to be very valuable, especially to founders that are looking to raise capital. And, I've given a few of these presentations on the power of equity crowdfunding and what it really means as an entrepreneur to go about such a venture and such an initiative. But let me sort of start from the top, right? And I actually just published an article in Forbes on this very topic, which I can also link to in the chat in a few minutes. So let's just take a step back, and I'll keep it very high level for those that want to know, what is equity crowdfunding? Is it right for me? And can I use this platform to raise capital for my business? So I'm going to start with two perspectives. The first perspective is going to be the founder perspective, and the second perspective is going to be the consumer perspective. So if you, as a founder of a business or a venture, want to raise capital, you really only have four major options. The first option is the very traditional, let me get a small business bank loan. The reason why that's not feasible anymore is because most banks require collateral, and most entrepreneurs, given the volume of companies being launched, don't have the capital or the collateral to get that capital. So that's usually not the best option or a viable option for most entrepreneurs. Then the second option is friends and family funding. Once again, for the vast majority of people, raising hundreds of thousands, potentially millions of dollars exclusively through friends and family is not a viable option. The third option being VC funding or angel funding, which, quite frankly, I have mixed thoughts for, and I have raised angel funding in the past, but most of the time VCs or angels or institutional funding only gets involved when you already have the fire and the ship's already sailing, and they're not really funding you at the early stages when you need the capital the most. So unless you have massive traction and an amazing team and proof of concept and proof of sale already established, VC and angel funding is kind of off the table, or unless you've had an exit before. So that's not really, a viable option either, or option number four, which is self-funding. Right? And once again, not really an option most entrepreneurs have to invest hundreds of thousands of dollars of their own savings into their own business. So you, as a founder, have to take a step back. Okay, so I can't get a bank loan because I'm not going to put up my house as collateral. I don't have extremely wealthy, high net worth friends and family that can cut me, $10,000, $100,000 checks. I don't have enough traction and revenue coming in to get VC funding or angel funding. Or I haven't saved $500,000 and I don't want to put in $500,000 of my own money to start my own business. So what option do I really have? And many entrepreneurs in today's world are battling with this question. And this is where equity crowdfunding really comes into play. And keep in mind, maybe 50 years ago, these four options were viable, but given the explosive growth of ventures being launched constantly, these four options no longer serve as a holistic pool for entrepreneurs to pick from. Now, this is where equity crowdfunding, as I mentioned, really comes into play. Now, we just talked about the CEO role, right? So let me put that to the side. Those are the four predominant options outside of equity crowdfunding. Now let's go to the consumer side for a quick second, right? If you, as a consumer or an investor, want to invest in a venture directly, up until recently, till equity crowdfunding became an option, you really only had two options. The first option was being an accredited investor. Now, what does it mean to be an accredited investor? An accredited investor means you have to have a net worth of $1 million outside of your primary residence, or make $200,000 a year or $300,000 a year joint with your spouse for 2 years in a row. Should you meet these two qualification criteria, you can get the stamp of an accredited investor and invest directly in a business. If you're not an accredited investor, you have to use a financial intermediary, such as a JP Morgan or a Bank of America or a fund manager. You give them your capital, they'll invest it on your behalf, but they'll charge you fees as well. So taking a step back, you have, as an entrepreneur or a founder, four major options: bank loans, friends and family, VC funding, or self-funding to raise capital for a business. And then on the right-hand side, as a consumer, you only have two options to invest in a business: either be an accredited investor or work with a financial intermediary that'll have fees and a bunch of rules around what can be invested in. You don't necessarily control where the investments are happening. They have their portfolios and algorithms where they invest on your behalf. So fast forward to up until a couple of years ago, the Obama administration launched what was called the Jobs Act back in 2012 and rolled it out over the course of 2012 to 2017. This 5-year rollout period was what the Jobs Act was rolled out. And the Jobs Act stands for Jumpstart Our Business Startups Act. This was meant to give businesses an alternative route of fundraising and to give investors an alternative route of investing. And it has, just in the past 3 years, already become a multi-$100 million industry. So just to give you some background on me, as Doug said, my name is Krishan Arora. I run an agency called the Arora Project, and this is what we specialize in. We specialize in raising capital for businesses through crowdfunding and through digital funnels. Over the past 5 years, we have fundraised over $100 million for over 200 businesses across digital funnels, digital marketing campaigns, and have fundraised over $50 million specifically through crowdfunding. Now, before we get into what the Jobs Act means and what crowdfunding actually means, when you are first being told about crowdfunding, most people think about Kickstarter and Indiegogo, which is not what this session is about. So crowdfunding as an umbrella, which is a brand new way of equity crowdfunding, a brand new way of raising capital for businesses, comes from a larger umbrella group, which is crowdfunding. Crowdfunding in the form of Kickstarter and Indiegogo has been around since 2010. That is a basic pre-order model, and I don't want anybody on this panel to confuse rewards-based crowdfunding, which is what Kickstarter and Indiegogo is, to equity crowdfunding. I mean, they're two fundamentally different concepts altogether. Rewards-based crowdfunding, which is what Kickstarter and Indiegogo is a pre-order model. Let's say Doug and I came up with a cell phone case that had a solar panel on the back, and we said, great, let's create one prototype of this product, and we'll go to Kickstarter. And we'll go to the online crowdfunding community and we'll say, hey, online crowdfunding community, pre-order this cell phone case from us, give us the money up front, and then Doug and I will go produce it, manufacture it, and ship it to you based on the pre-order funds that you give to us. There's no equity being exchanged. There's no shares being exchanged. This is a basic pre-order model of getting the capital upfront from consumers and delivering to them a physical product 3 to 6 to 9 months down the line. That is what crowdfunding was up until equity crowdfunding came into play. And that is what Kickstarter is, which is rewards-based crowdfunding. When the Jobs Act was passed, specifically the Title III reform of the Jobs Act, it allowed for businesses to raise capital directly from the consumers. not giving a product in return, but giving equity in return. And the power of equity crowdfunding is it allows for unaccredited investors to invest directly in high growth ventures using their credit card. Up until 2017, this was not possible in the history of the United States of America. So when that rule was passed, many people saw a massive opportunity to get involved with equity crowdfunding. Two major platforms started. Now there's about a dozen medium to small size platforms, but the two biggest ones, in my humble opinion, is WeFunder and StartEngine. They started when the Title III reform of the Jobs Act was passed that allowed for everyday consumers, or what we call retail investors, moms, pops, cousins, friends, family, to take out their credit card and for as low as $50 or $100, invest directly and buy micro shares in companies all across America. So when that happened, it really started a massive industry of equity crowdfunding. And just over the past few years, WeFunder has fundraised over $130 million for over 200 to 300 businesses. And StartEngine has done equivalent, 130, 40, $50 million, if not more, for hundreds of businesses through equity crowdfunding. So that's just a premise to set the stage for what two amazing founders that I have had the opportunity to work with, Krishan Arora from Everydae and Joshua Resnick from Parallel Flight Technologies. We just finished Krishan's equity crowdfunding raise and raised her about 1.3 million. She led the entire ship and did such an amazing job in raising a 7-figure round through equity crowdfunding. And when Krishan does go up, I want everybody on this panel to really understand her perspective, because to be successful in the equity crowdfunding world, you have to be as tenacious and dedicated and on top of it as Krishan was. And Joshua from Parallel Flight is our current equity crowdfunding campaign that we're running in 2 different phases that he can talk to, and having the network and the tenacity and the dedication that Joshua has as well is what's going to be required to be successful in the equity crowdfunding world. So taking one final recap, as a business, 4 major options to raise capital: banks, friends and family, VC, and self-funding, which aren't really an option anymore for most people. And as an investor, either become an accredited investor or use a financial intermediary. Equity crowdfunding sits right smack dab in the middle of those two, where you as a founder can raise capital from your social media followers, from your email list subscribers, from your community members, your friends and family, and anybody around your ecosystem for as low as $100, if not lower. And really allow you as a business to raise capital in a very creative way. And the beauty of raising capital through equity crowdfunding is not only do you raise capital in a much faster, effective route than going down the VC model, but you also create brand advocates and loyal, fans that want your success and want to support you above and beyond giving you a couple $100 in exchange for equity. And you as an investor who's not accredited or doesn't want to use a Bank of America and have their minimums of investments or pay them their fees, gets to, on your accord, invest directly in startups all across America and create your own portfolio for microtransactions of shares that you can buy for a couple of $100 in general. So I hope over the past 10 minutes of me giving this, I've laid the premise for the conversation about to come on, where equity crowdfunding came from, what was the inception around it, the Obama administration rolling in the Jobs Act, allowing for unaccredited investors to invest directly, and what the boom has happened in equity crowdfunding already in the past 3 years, becoming a multi-$100 million industry for businesses, specifically early stage startups, to raise capital. And the last point I'm going to get at is, Doug, if you could load slide 12 really quickly on the presentation. I'm just going to give the 3 different tiers of equity crowdfunding, and then I'll hand it back off to you, Doug, to give the panel discussion topics and allow for the amazing founders that I've personally had the chance to work with, Krishan and Josh, and the many other people involved in the panel as well, to give their feedback on, what is it. Toby and Todd can also give their feedback on what this entire panel is needed. And great question from coming in the chat. Republic is another great platform. They're definitely top 3. And what type of documentation is needed? Thank you all for getting those questions into the chat. I'm going to talk about what type of documentation is needed, and then get into the 3 different forms of equity crowdfunding, and then hand it back off to Doug to give the other panelists time to speak. So to Josh, to your point, Republic is an amazing platform as well. They've also raised a ton of money. You can Google online. They're the StartEngine, WeFunder, Republic, Seed Invest. and a couple of other smaller ones, but those four primarily own the lion's share of equity crowdfunding platforms. And if any of the viewers here want to get a data-driven perspective, a good friend of mine, Chris, runs a platform called King's Crowd, KINGS-CROWD. If you look up King's Crowd, they're the analytical sort of data collector of the entire equity crowdfunding world. They'll give you month over month what all the platforms are raising, what deals are the #1 deals for this month. So they're a great place to start if you want to think about investing in companies, or as a founder, if you want to learn more about equity crowdfunding and what works, King's Crowd is a great platform to do it. To Adam Gordon's question, what kind of documentation is needed? Now, this is where things get pretty crazy, Adam. This is how booming and how amazing the equity crowdfunding world actually is. What equity crowdfunding did, or the industry did, was the SEC realized COVID-19 is really impacting and economically negatively impacting businesses all across the globe, specifically the United States. So pre-COVID-19, you had to have two different things done before you can launch an equity crowdfunding campaign as a founder. And Christine and Josh can talk to you about this in great detail. But from a high level, you have to have your audited financials done, which means a third-party CPA accounting firm has to come in and review your financials, talk about your profit and loss, P&L, and give a lot of breakdown into what is happening with the financial history. And then you also have to fill out a form called the Form C, which Josh and Christine and the entire team can get into in a great amount of detail, what those specifically mean. But those two on the Reg CF level have to be done. Audited financials through an accounting firm and the Form C. The beauty of working with a WeFunder or a Republic or a Start Engine or a Seed Invest is this onboarding is already baked into their platform. They will review your financials for you. They will fill out the Form C for you. They'll help you fill all this out, and they'll just take a percentage from your total fundraise. So don't worry about the legalities behind it. Once you partner with a FINRA SEC licensed equity crowdfunding platform, the platform does all the legwork for you. They just take a percentage of total fundraise and really guide you through the entire process. And finally, just to wrap up my portion of the talk, there's 3 different types or regulations of equity crowdfunding. When most people talk about equity crowdfunding, they're predominantly going to be referring to Reg CF equity crowdfunding, which is what Christine from Everydae just did very successfully in partnership with us. Reg CF allows for us to raise $1,070,000 in a calendar year of 12 months from a pool of unaccredited investors or accredited investors as well. It's not expensive to kick off. It's actually pretty seamless to kick off. And this is how topical equity crowdfunding is. And I'll get to Reg A and Reg D in a second. When COVID-19 hit, the SEC and the financial authorities came down and said, hey, you no longer have to do your financial auditing to launch an equity crowdfunding campaign, because the financial authorities within the United States wanted startups to raise capital through equity crowdfunding without going through the steps required to do it. So this is an industry that's actively being adopted and evolved by the financial authorities. Not only did the financial authorities of the United States remove several steps required for launching an equity crowdfunding campaign, specifically a Reg CF campaign, but just this year, about a month ago, the financial authorities increased the cap from $1,070,000 to $5 million for Reg CF campaigns, and increased the cap from $50 million to $75 million for Reg A. So this industry over the past 3 years has just blown up into a multi-$100-million industry. The caps from $1 million to $5 million have been increased. That should be rolled out over the next 12 months. The million from 50 to 75 million have been increased, which will be rolled out over the next 12 months. So this is a very timely, amazing, creative way to raise it. And to Josh's point, that's exactly right. Without the audited financials portion, you can raise up to $250,000 because of the COVID SEC changes that was done. And as a final point from my side, Reg CF is the easiest equity crowdfunding regulation to go down, $1,070,000 from unaccredited investors, which is really the key here, right? You want to go to friends, family, email list subscribers, social media followers to raise capital up to $1,070,000. Reg A is more of a serious fundraise. You can go up to $50 million will be 75, but for our purposes, 50 million. It takes 2 to 3 months to do the paperwork. It's expensive. It's going to take you 50, 100,000, maybe more to do the paperwork and the filing. And you have to do the Form 1A, and the Reg D has no limit to how much you can raise. And it's accredited investors only, which is what Josh from Parallel Flight will get into and can speak to as well. So with that, I'll take a pause. If anybody has any questions, please type that in the chat. But that's my overview for now. And there's many amazing panelists behind me that will give you a great insight into what's about to come with equity crowdfunding.
Thank you so much, Krishan. There are some questions in the Q&A if you want to type them in before. I know you have to run off to a board meeting here, but please, if you can, get to them.
Yep.
I really like the Reg A version here, so very cool. All right, we're up next is Toby. Toby, do you want to turn on your video?
Let's see here. I think it's got to be approved, Doug. There we go.
No.
Hey, you guys see me okay?
Yeah. Thank you,
Awesome.
Krishan.
Yeah, Krishan, that was an outstanding overview. Congratulations on highlighting how the program works. We're going to kind of dive into the details here. We got 3 amazing entrepreneurial startup CEOs that are going to walk us through that. So here's what we're going to cover. I'm going to set everything up with a discussion on the entrepreneur's journey, which is really critical of understanding how to get your company funded, understanding the landscape, and then we're just going to get right into the panel discussion. We're going to cover 3 broad areas. Number 1, what's critical here is that, is my startup fundable? So our CEOs are going to talk about what they had to do, what kind of business metrics investors were looking for, how to optimize the business in a way that made the investment something that was exciting and enticing to potential investors. Once that piece is, then we're going to talk about crowdsourcing funding and other options, grants. There's many other opportunities, but we're really going to focus on this new crowdfunding opportunity. And the team's just going to really go over the nuts and bolts, how they did it, so you understand exactly, roll up your sleeves way of how this gets done. And then once you understand this opportunity that's available to you, it just doesn't stop where you list your raise on one of these crowdfunding platforms. A lot of work that has to happen. How do you market it? How do you reach the right investor? That's incumbent on the CEO and the startup to figure all of that out. So we're going to cover that area as well. And then lastly, hopefully we'll take some questions on and hopefully get everyone's questions answered. So Doug, can you hit the next slide? So real quickly before I introduce our amazing panelists, this is a good way to think about the startup's journey and how you move forward. So just so everyone understands, finding investors is challenging because number 1, 9 out of 10 startups fail. So there's a very high failure rate in the startup world. So investors know that these are risky, so they're looking for very high returns. And there's typically 3 elements that are really critical from an investment standpoint. And the 3 reasons why startups fail. Number 1 is that there's no product market fit. So the idea that you thought you had, the problem that you were solving, turns out either the idea was flawed or the execution of the idea was flawed, and there really is no need for your product or market in the marketplace. And there's no customers, no need, startup's going to fail. Second reason why startups fail is the wrong people. I like to say is you got to get the right people in the bus, and you got to get the right people sitting on the bus. So having the right people on board is really critical. That's a really important attribute that goes into an investor, one of the checklists the investor has in looking to invest in your startup. And then lastly, third reason why startups fail is because they run out of money. Could be a great idea, and for whatever reason, they're having a really hard time getting money raised, they run out of cash, can't meet payroll, can't meet their expenses, and unfortunately, we see some great companies that have just really run out of money. So we want to share some insights into how to avoid that. As Krishan just teed up for us, there's an amazing new platform that has emerged. So let's get into it. Let me ask our amazing panelists to introduce themselves, starting with Joshua, and then we're going to dive right into our agenda.
Hey, everybody. Can you hear me okay?
Hear you great.
Great. Yep. Joshua Resnick, one of 3 co-founders and CEO of Parallel Flight Technologies. We are based here in the Santa Cruz area, and we're building heavy lift drones, and we're using them for supporting wildland firefighting as a primary application. But a lot of other applications outside of that, including construction, pest eradication, agricultural, and the list kind of goes on and on. So we have new technology. We're funded by NSF, NASA, and now also USDA through the SBIR program. So, I mean, that is something we should touch on a little bit in this conversation, but that is the background of Parallel Flight and myself. I'm super happy to be here. Thanks, Doug and Toby and all of the other panelists.
Awesome. I'll go next.
Or Christine.
Yeah, Christine Utram, CEO of Everydae. We help high school students ace high school without the stress. Most high school students need help getting from 9th to 12th grade and then up into college or career, but things like tutoring are prohibitively expensive for most families. So with Everydae, you can ace your classes through 10-minute micro lessons that adapt based on your needs and goals. And unlike a tutor, which starts at $75 per hour and up, we start at $19 a month. So excited to be here. I think one of the reasons why I was invited on the panel is that we raised, as Krishan mentioned, almost 1.3 million through WeFunder, and have a lot of experience kind of with the just nuts and bolts of the process and how to kind of architect a campaign, how to entice people kind of into the raise and keep them investing over the 3 months or so that we raised that money. So happy to be here. Thanks.
Awesome. Todd.
Hi, I'm Todd Thompson. I'm one of the co-founders and the CEO of Carnot Compression. And we are bringing a more efficient air and gas compressor technology to the market. We've been through many of the cycles that Toby laid out in his chart, but we've been funded by the National Science Foundation and the California Energy Commission. And we have just recently kicked off an equity crowdfunding raise on Startage. So happy to be here as well.
Awesome, congratulations. So let me just share some stats and then we'll get into a panel discussion. Historically, you had really a couple options. Well, you could self-fund yourself, SBA loan, those really aren't available unless you have a personal guarantee and you're willing to make. And then so you tap your friends and family out, and then it was really just VCs. So $136 billion was invested into the VC space last year, 130 million prior to that. Over the last 10 years, $1.5 trillion have been invested into venture capital space funding startups. The challenge, though, is that for VCs, they typically have a lot of analysts that are out searching for companies. It's very rare that they will reply to a blind email coming in. So of the universe of startups, maybe 10% will get a meeting with a VC. And then maybe of that 10% that's lucky enough to get a meeting with a VC, 10% of that will actually get a term sheet or get funded. So that's about 1%. So it's a very narrow band, and it makes it really, really difficult for some really great ideas and some really great entrepreneurs to be able to raise the necessary capital to get their business off the ground. Hence this new equity crowdfunding opportunity started. So let me kick things off. The first thing that's really most important is that, is my startup fundable? So let me start with Josh on kind of where you took the business, how you got in the market, started generating revenue. From your experience, what kind of metrics are really critical that these types of investors are looking for?
So it's a mixed bag with crowdfunding, in the sense that if you were going to a venture capital firm, they would want to see an incredibly well thought out business plan where you have a very clear, you've demonstrated product market fit, on and on, all the things you talked about. When you're going to crowdfunding, it's different because there are groups of investors that will want to see all of that, but by and large, the crowd wants to get behind ideas that they believe in, right? So they certainly want to make money on the deal. They want their investment to do well, but they are also interested in doing good. And I think, with our company, when I founded Parallel, I really wanted to go after the wildfire problem. And the second I said that to multiple VCs, I go to the VC meeting and say, hey, we're doing wildfire. They'd be like, yeah, we're not interested. That's a slow market, long sales cycle, blah, blah, blah. But when I said that to the crowdfunding community, they're like, this is great because my house burned down in a fire and I want to support what you're doing. Since then, we've seen that there's a much broader market beyond wildfire. But the point is that you can also get investment into ideas that are going to do good as well as make a profit. So
Josh, let me let's get down a little bit, and then I'll open up to the panelists. But more importantly, is it just, can an idea get funded? Do you need a minimum viable product? Do you have to have any customers? Do you need any revenue? What do you think the bare bone minimum? And I know that every case is different, but in aggregate, what does that look like?
Yeah, so you can't just get an idea funded, right? Like, I mean, unless you have previous success. Like, I know entrepreneurs who've had previous successful companies that then went to crowdfunding with just a sketch and raised $1 million. But that's already because they had 10,000 followers for their previous product that knew them. They had the email list, so it was easy. But if you're just coming with an idea, no, that's not going to work. You have to have something. So what we did is we had a working prototype of our technology that we had funded with, in our case, it took $250,000 of family and friends investment through a SAFE to fund our working prototype. We demonstrated that. Then we also had a bunch of customer LOIs lined up. And so we demonstrated the product market fit with that. And then we made an awesome video, right? Again, with local Santa Cruz video company, put that together for us. So with those elements, that was able to raise that fully subscribed, actually oversubscribed equity crowdfunding round.
Got it. And then Christine, to you, what was your experience in feedback and where you needed to be in terms of tangible deliverables and results, product and MVP, any customers? What were those elements and metrics that were critical to your success?
Yeah, we definitely had metrics, although really we were kind of about the team. I think each company has something that people, kind of look to invest in. So we had some proven success previously. We'd worked together previously. And so even though we had just launched our product fairly recently when we crowdfunded and didn't honestly have that much revenue or customers, it was what the mission was and what the story was, as well as the fact that we'd done it before, that I think really allowed people to have that trust. And I mean, while we're on it, I think the entire campaign, putting up your profile on the platform is one thing, but the entire campaign is about architecting trust. It's about what news can you give to your audience in order so that every single time they see you, each time they have more trust in your business. Whether it's, oh, hey, last week we showed you this metric, this week we improved on this metric. Or last week, kind of we talked about the team. This week, let us go a little deeper into a member of the team and how amazing they are in their background. So I think it's about building that relationship with investors through things like updates on the page throughout the entire campaign that actually then, even if you don't have that very initial traction, will kind of get investments in.
Okay. And then Todd, I know you had some success with a grant, which was non-dilutive. And overall, what's been your experience on where your company needed to be and how it looks like in this landscape and the success you had with securing a non-dilution grant?
Well, thanks. And there was a question about SBIRs earlier as well. Yeah, grants have been critical to our company and getting us from desktop proof of concept to a working, fully integrated prototype that we're currently testing. We've had over $3.5 million of non-dilutive funding being invested in the technology through NSF and the California Energy Commission. Honestly, without that, we probably wouldn't be to the point where we're ready for an equity crowdfunding raise, because we're in a market it's a huge market, but it's dominated by very large multinational players, and innovation is very rare. Innovation is making 1% and 2% improvements on the same technology that they've been selling for the past 30 or 40 years. So, we've come out with something just radically different that's got very high upside potential, but also has a lot of technical challenges to bring to market. So, our technology was very well suited for programs like NSF and CEC because it's got a tremendous upside in terms of environmental benefit and energy savings. But what gives us, what made us appealing to those agencies also in a lot of respects made us unappealing to institutional investors in venture capital, because we had to work our way through those technical risks, and it's hardware. It takes time to test and iterate and retest, and not everything can be done through simulation, and it has to be done through physical prototyping and testing, and all of those things are what make VC shy away, because that's a long development cycle, and it doesn't fit an NPV model when you've got 3 or 4 years of development before you've got revenue. So we were fortunate to be able to use grants to work our way through that valley of death, if you will. And now we're really at a point where crowdfunding makes sense because we've got first revenue in our sights. So
well, I think the three of you are also highlighting some really critical points, which is that the VC world is a one-trick pony or a one unicorn pony. They're looking for something that's going to be $1 billion, super explosive, super disruptive. Because they get 80% of their returns from 20% of their portfolio. So it's an entirely different model. And these business opportunities that you guys have uncovered don't meet this lofty checklist. And up until crowdfunding, there wasn't a lot of good opportunities to continue to finance your business. So let's shift on to the second piece of our discussion, which is now, hey, crowdfunding sounds really great. I think I'm ready for it. Josh, why don't you kick us off with the nuts and bolts? So you decide you want to do that. How do you get it done? What do you need to do? What are the nuts and bolts?
Yeah. So Toby or Doug, can you share my slide, which is the diagram of how crowdfunding actually works? So great. Awesome. Cool. So this is a diagram of how crowdfunding works. And first of all, you've got your startup and you're ready to crowdfund. Now you got to pick your platform. This is really tricky because it's hard to know the differences between platforms at the beginning. I am still learning about the differences. I did my first raise on Start Engine, and now we're currently doing a raise on WeFunder. So I'm learning about the differences all the time. But basically, you've got to make a choice at the beginning because you got to pick a platform. But I recommend you pick one of the top raising platforms. There's 2 or 3 at the top. WeFunder, Republic, Start Engine, look into those and pick one. Then the way it's structured is there's going to be an escrow agent, and the crowd puts their money into escrow. And then you, as the startup, will get your investment. You eventually will come out of escrow to you. You will then give your shares to a transfer agent, which will then which then holds them for the crowd. And then money will go to a marketing agency, and also directly to advertising. So in our raise, for example, we spent $45,000 on Facebook ads, and that generated $500,000 in investment. The rest of our investment came more organically, but we also paid a marketing agency to build those Facebook ads and manage them, because that is non-trivial. So I think the main pieces are, you've got the platform, which you pay, you have the escrow agency, which you pay, you have the transfer agency, which you pay, you have the marketing agency and advertising. But at the end of the day, you still, we walked away from our 1.07 million raise with around $900,000 in cash. So it really does work out. And if you can do, and there's ways to even save more on that. So that's kind of the big overview. And like Christine said, and I'm sure she'd be happy to speak to this, you have to do a lot of work to manage your investor base while the raise is going on. You have to do a lot of work to manage your advertising. It's not like you just throw your deal up on the platform and click go and $1 million happens. That's not how this works.
Okay, so Christine, let's kill a couple of birds with one stone. What materials did you have to get together to execute your campaign? And then there are 2 other questions that I'll throw out to you from our audience. What type of security did you actually sell? Was it preferred? Was it common? And then what was the impact on your cap table and dilution and ownership?
Great. So to answer the first part, the two things that we had to get together before we could even launch the capital, kind of deciding how we were raising and what that looked like for investors, and also then our accounting paperwork. I want to make a distinction here. I believe at Reg CF, you actually don't need audited financials. You just need reviewed financials, which is actually a much cheaper thing. So, you can get them down between $2,500 and $5,000 for all of your financials. Versus once you go to the other regulation crowdfunding campaigns, then you need fully audited financials, and that's a much more expensive exercise. But getting those together and getting our profile together took us about 6 to 8 weeks, but also we were coming up against the holiday period as well. We didn't want to launch in the holiday period, so we launched in January. So that's kind of everything that we did to get things together. In terms of the type of offering that we had, we raised on a crowd safe. And the question around how did that impact our cap table, the most common thing, well, it used to be with equity crowdfunding that commonly you'd use a safe and all of those investors would convert to be on your cap table at the next qualified financing round. The problem with that is that sometimes you'd end up with 1,000 investors on your cap table, which does not look very good to VCs if you decide to go that route. Kind of having 1,000 small investors on your cap table just doesn't feel good. And so now what most equity crowdfunding platforms do is they actually have you invest, there's a special purpose vehicle that actually is just the one line on your cap table and wraps all those people up into one line. And you have a lead investor that is actually signing the paperwork on behalf of all those other micro investors for you. We actually did things a little differently. So the way we structured our safe is that it does not convert at the next qualified round. It only converts at a liquidity event. So a sale, an IPO, merger, that kind of thing. We did that so that we could kind of avoid that next round, hundreds of people on the cap table, thousands of people on the cap table issue. And so we kind of kicked the can down the road to further event.
Got it. And Todd, I think you said you were getting ready to launch a crowdfunding campaign. Tell us what you've prepared, what the timing looks like, and how you're going to do it.
Okay. Yeah, so we just launched about 3.5 weeks ago on Start Engine. And for us, the biggest challenge was we were an LLC. And so we converted to a C Corp prior to the launch because we didn't want to have, being an LLC and having hundreds or thousands of people signing an LLC membership agreement was just too cumbersome. So we went through the process to convert from a Delaware LLC to a Delaware C Corporation. Most of the marketing material we already had, so that was pretty straightforward. We had a video that was a product demonstration video that we repurposed, and we added some interviews with myself and our marketing director. We're on Start Engine. Their team was very good on the creative side and working with us, and the creative firm that we use to get our campaign launched. And right now we're really moving from kind of the soft launch to paid advertising. And like Joshua said, he told me, and Joshua actually recommended Start Engine to us, before we made the decision to go on the crowdfunding route. But we're just getting into that process where we're starting to do paid ads. We've tested some ads on Facebook. We're going to do a LinkedIn campaign. So we're just kind of transitioning into that, really all out blitz on the marketing side right now. So.
Got it. Very cool. And Josh, I think you actually did a different structure. I know Christine talked about a safe, a simple agreement for equity. Yours was a equity, and I think it was common, correct? Common shares?
Yeah, we did common stock. We did a priced round for our first round. And, we do have thousands of people on our cap table. And that, you know, that's one thing with Start Engine. That's how their structure works. We're probably going to shift all those people to an SPV a little bit later on. Now we're actually raising another priced round right now, but it's Regulation D for accredited investors only, and it's private on WeFunder right now, and it's actually going really well. And that's also common stock, and then and this is yeah. Anyway, and we're going to be doing yet another price round after that on the Regulation A side as well.
Okay, cool. All right, guys, one quick question then. There's a bunch of Q&A where we'll tackle some of those. But so we talked about what it is, the mechanics of it, how to get there. That's only half the battle. You've got to figure out how to market yourself. You just doesn't magically put it out there and then people start writing checks for you. So let's start with you, Christine. Tell us a little bit about how you marketed your offering, and what were the elements that allowed you to succeed.
Yeah, actually, I was going to post in the chat as well, and I'll do this afterwards. I wrote a fairly kind of lengthy blog post about all of the different techniques that we use to get investors to our page and then convince them to invest. So a series of different things. I think the biggest piece of advice that I could give is you want to find somebody who can actually spread your message for you. So there are a lot of kind of deal sites for equity crowdfunding that are popping up. So people who recommend different equity crowdfunding deals to their network of investors. One of the biggest two are Startup Camp with Chris Graby, and then Neil Patel's Angels and Entrepreneurs. Both of these groups have a network of mom and pop investors across the country. Angels and Entrepreneurs is 70,000 plus. And then Startup Camp is a little smaller, but still kind of growing rapidly. And so getting yourself on their podcasts, on their deal lists, and that kind of thing is probably the biggest impact on our campaign outside of our advertising, because we could do deals there. And, you know, for instance, with Angels and Entrepreneurs, we ran a limited time offer where we dropped our minimum for 500 to 250, and we ran it for 5 days, and we made a kind of, you know, an offer for the Angels and Entrepreneurs community, and it just spiked our investments. So it was about architecting a little bit of FOMO. It was about kind of getting to those groups that have a much bigger network than we do, and then complementing that with advertising. So.
Got it. And then Josh, tell us about how you found this marketing agency. Did they do it all for you? Did you do some on your own? And how were you able? What were your marketing tactics and strategy?
Yeah, so we didn't have any kind of community starting. We really had to build it from scratch. So the first thing we did is we hired Impact Creative, which is a local Santa Cruz based studio, to do our video. So we had them come out, shoot the drone flying, shoot our team, you know, all that stuff. And it was super great. And the product was really high quality. And then what we did is we launched our raise. We brought in as many family and friends as we could. And this was really, really crazy, because we raised, so when we first started the company, we raised $250,000 from family and friends accredited. But then when we did our Start Engine launch, we raised another $250,000 because all the unaccredited people could then come in. And so between the three founders, we just had a lot of people in our network. And that really provided a firm basis to build on. And then what we did is we had Start Engine Promote, which is kind of an internal marketing agency within Start Engine, build a bunch of Facebook ads. And then we started a Facebook campaign. And really all the advertising we did was on Facebook. We had some articles here and there, but really, I have to just say it, Facebook is what drives the traffic. It drives the traffic. We spent $45,000 over the campaign, very carefully on Facebook. We ended up with over a 10x return on an ad spend, which is very high, like it's incredibly good. And that really boosted our campaign. And then the rest of it was just all organic traffic on Start Engine, just poured in and oversubscribed the round. This time around, we're working with Arora Project and they're for our WeFunder campaign. And so it's a little bit of a different structure, but it's the same idea. There's going to be a lot of social media push. We're going to be working with Angels and Entrepreneurs as well. So stuff like that.
Got it. And then Todd, what's your plans on the marketing side and how you're going to reach potential investors?
Sorry, the dog was barking, so I had to mute.
No
we, so we just started Facebook ads at the end of last week. So we're kind of in the test period to, see what works best and, become a little bit more targeted. I'll agree with Joshua. The site traffic has really spiked since we started doing the Facebook ads. We haven't yet seen the ROI, but again, we've only been doing them for a few days. So, some other things we've done a lot organically through blast emails, through our network, our broader network, LinkedIn post. I did a podcast about a week and a half ago. One of our challenges is, we've kind of been in semi-stealth mode for a while. And so, we've had to go out and establish a social media presence. So, we didn't have a Facebook page prior to the launch. So we're just kind of getting out and getting on social media and really starting to build broader base and get the word out there. So
very cool.
If I had it to do over again, I would have done all that, a couple months before we launched, but
Yep.
Live and learn, right?
Yeah, I hear you. All right, folks, we got about 10 minutes left. Let's grab some questions from the Q&A, and you guys feel free to jump on it. So one of the questions that's come in is, do the crowdfunding platforms give you an indication of who their audience is? And then are the users and audiences of the crowdfunding platforms very different? Who wants to take that?
Yeah, I can take that. So they're not going to tell you that much. The one thing I have found out though is Start Engine has a lot more unaccredited investors. I think it's kind of like 80% unaccredited, 20% accredited. WeFunder is more like 60% unaccredited, 40% accredited. But you got to do a lot of digging. Like that's non-trivial to figure out.
Got it.
And I think we're seeing which companies have been funded in the past on those platforms and how much they raised, could give an indication. One thing we did is we went across, even though we were raising on WeFunder, we went to all the other platforms, saw all of the education tech companies, looked at their investors, and actually got someone on Upwork to scrape all of their names and find their emails so that we could hit them up as well, because we knew they'd invested in ed tech before.
Got it. Okay, cool. Another question can businesses be investors? So if so, what have you seen in terms of a split between individuals and businesses? I suspect this may be an interesting tool to drive strategic investors from potential business partners. But right now, is it just individuals, or are you guys seeing any businesses in the mix?
I saw just all individuals and then some, family trusts.
Yeah, we saw family trusts as well. And then just some, people's personal businesses, but not,
Yep. And then this might be a little bit too premature, but on the investor side, are there any examples of crowds who have actually managed to exit their investment at a profit? Or is it just, I know that, typical VC funds typically have a 10-year horizon. Are there any early stats or proof points, or are we just too early in the cycle right now?
There's been some unicorns. I don't have the list on the top of my tongue right now, but I can try to do some follow-up. But I don't have stats for like the overall majority of companies that are doing crowdfunding, because it is pretty early.
Okay, and then do you guys have thoughts on so one of the questions was, how do you value the company pre and post funding? But there's Christine's got a different route, so she's got to kick the can down the road with a safe/debt structure where you push off the valuation question down the road. But do you guys have thoughts on point of view? What's better, or preference?
I mean, I don't know necessarily. You got to ask like, what's better for your investors or what's better for your company. In our case, like all of our family and friends put into our early safes, and we wanted to make sure that they could get as much equity as possible, just because they put so much in. So we, that was part of the thinking with our priced round, and coming up with a valuation was really painful. Like the thing is, we went through contortions on this. We used several different methods. We've done that again for our new rounds. And at the end of the day, like you just have to think about like what is going to be. There's a lot of methods out there. You should look up on how to do this. There's methods based on revenue predictions and stuff like that. You know, if you want to hit me up individually, I can provide some tools for that.
Okay. And then Todd, are you doing a what structure are you raising?
So we're selling common equity. It's a price round, and yeah, I would agree with Josh. It's valuation is more of an art than a science.
Yeah.
You know, we tried to pick a valuation that we thought was fair. You know, we've got DCF models. You know, we've had discussions with larger investor groups in the past. But, you know, at the end of the day, it was, well, you know, what's fair? I mean, we tried to kind of balance, you know, the valuation that our early investors and friends and family had gotten in at, and, you know, tried to leave ourselves some room so that, you know, if we need to go out and raise more, or maybe raise a larger round in the future, that, you know, we could do so in an up round. And so that's,
and is that common? It's common stock or preferred?
It's common. So that was another thing we did. We had 2 classes of membership units in our LLC, and we converted everything to common, and we're offering common. So we've got a very simple equity structure in our company now, just 1 class of shares. And, you know, the other interesting thing about managing the, you know, hundreds or thousands of investors is, you know, with our round, the investment is structured as, you know, all of the voting proxies go to me, or, you know, or my successor as company CEO. So we're not giving up any voting rights in the offering.
Got it. And then Christine, you just felt where you were, a safe structure was the best for both your new investors and for your company?
Yeah, I think at the stage that we were at, we weren't quite ready to put the valuation on the company. And so having that safe structure with a cap, no discount because it's at liquidity, that made the most sense for us.
Yeah. Okay. Very good. Okay. We'll probably have time for a couple other quick questions, but this one definitely I think is pretty relevant here. So complex or heavy populated cap tables sometimes inhibit the ability to raise subsequent venture or angel financing. So what's your opinion on the perspective of equity crowdsourcing from the institutional investment side with these, you know, very large, potentially unruly cap tables, individuals on your cap table?
I can.
Yeah, please.
I've heard both sides from institutional capital. I think some VCs will not invest in companies that have done crowdfunding. They see it as a negative signal, as, you know, you couldn't raise from VC, therefore you had to go to crowdfunding. I think that perception's changing as people see it as an alternative way to do early financing. So that's definitely something that I've heard from the industry and from VCs. Then the heavily populated side of it, I think the industry is changing so that you do only have that one line on the cap table, and that you are giving your voting rights to the CEO or, you know, whomever has the votes, so that it becomes less complex. Unless you have a major investor, sometimes, you know, kind of these safes or structures say if you invest over 100,000, then you have voting rights, or, you know, whatever threshold you want to make it. But yeah, the industry is changing quickly, I think, and I think we're learning as we go how to not have equity crowdfunding be a big black mark against you if you go on to raise VC. A lot of people who've raised equity crowdfunding, myself included, are really just, and, you know, Josh definitely, are considering going this route, you know, versus VC as well.
Yeah. I think it's a great route, because when you take VC money, there are all kinds of new stuff that comes with that. So they typically take a board seat. They also have operating controls that they begin to insert. There's lots of terms that where they're sitting on top of a preference stack. And this platform just allows you to do what you really want to do unencumbered. You have a vision for your product or service. You know who your customers are. And this really gives you guys the freedom, at the same time, the working capital and some momentum I think, to go and build your business. So it's really awesome to see it working, to hear your examples on that. And we got time for one last question here. So are the companies that receive money through crowdfunding required to communicate to their investors at certain intervals? I've invested in some small ventures in the past, and most of them only communicate maybe once a year. So I'm wondering what your thoughts are, what responsibilities you guys have to your new crowdfunding partners.
So by law, you have to file a report with the SEC once a year if you've done Regulation CF. What I do, though, because it seems wrong to not communicate more with your investors, I do a quarterly report for all my investors that's more newsy, not necessarily the financial report. And then we do the yearly financial report. And then while I'm actively raising, I do a bunch of webinars, and I even send out Calendly links to 1,000 investors. If they want to talk to me, they can. It's crazy, but it works. And, I don't get flooded. I have a webinar later today. I've got like 30 people signed up. I had one last week. I had, like 70 people come. It was great. And it's bringing in the investment. So I just try to communicate as much as possible.
Fantastic. And Christine, what are your thoughts on what kind of communication regime are you thinking about?
More kind of in-depth quarterly updates. But I mean, the great thing about WeFunder is that, they have a little update section, and I can just quickly, kind of type, oh, this happened. Here's a bit of news. We got accepted to this accelerator, or, we just, hit some sort of milestone. And I think it really helps to make investors feel involved and engaged. And so I see that as kind of the CEO's responsibility, is to, make sure that we're communicating outwards. And the more that I do little updates, the less incoming requests and things that we're getting. Not that I get any or many at all, but I think, that's something that people appreciate.
Great. And then Todd, what you're thinking on communication?
Yeah, well, it's going to be a transition for us because, in the past, it's been, me just communicating directly with, the 8 to 10 people that owned all of the company. And so, I talked to all of our, major shareholders every other week, pretty much.
Yep.
And now, we're going to move to something, probably a quarterly newsy type update, like Joshua said. And, it's going to evolve, but there's definitely going to be more kind of formal, structured communication that we have going forward than we have in the past, where everything, like I said, has been, with a very small cap table, easy to do, much more informally.
Yeah, awesome. Well, look, we've run out of time. This was an amazing session with all of you. I think everyone's got contact information for Joshua, for Todd, and Christine. I want to thank the three of you for participating, sharing incredible knowledge and wisdom with us. This was incredibly, really insightful. Hopefully our audience members have gained a huge amount of new knowledge and insight into this emerging platform. Of the $136 billion spent last year in VC money, almost $17 billion in crowdfunding. I do think it's the future. I also want to congratulate our three entrepreneurs on continuing to work through the valley of death, as they say. All three of you have got great startups. You're off to a great start. Congratulations on getting these funding rounds done. And I look forward to watching you continue to grow and do some great things. Doug, back to you.